You are not bad with money. That is the first thing I want you to understand. Because every personal finance video you have ever watched has subtly implied that you are, that your problem is discipline, willpower, some moral failure buried inside your relationship with a credit card. That is a lie, and it's a convenient one. Because if your overspending is a character flaw, then no one has to explain why the entire modern retail economy was architected from the ground up to make spending feel automatic and saving feel like punishment. Here is the number that should bother you. The average American household carries over $11,000 in credit card debt. Not total debt, just credit cards. And the average interest rate on that debt right now sits above 20%. That means if you only make minimum payments, you will spend years, sometimes over a decade, paying back money you spent on things you probably cannot even remember buying. You bought something, you forgot what it was, you are still paying for it. That is not a discipline problem, that is a design problem. And today, we're going to fix the design. These are 15 small habits, not a budget overhaul, not a lifestyle transformation, small habits. The kind that quietly rewire how you relate to money without making you feel like you're living inside a financial boot camp. Let's get into it. Impulse buying has a lifespan. Research out of consumer psychology consistently shows that the emotional urgency around a purchase, that "I need this right now" feeling, drops dramatically within 48 to 72 hours. Not because you become wiser, because the dopamine spike fades. Retailers know this. It's why flash sales exist. It's why countdown timers exist. It's why only 3 left in stock exists, even when there are 300 left in the warehouse. The habit is simple. Anything non-essential, anything above a threshold you set, maybe $30, maybe $50, goes into a list, not a cart, a list. You wait 72 hours, then you revisit it. Most of the time, you will not buy it. Not because you disciplined yourself out of it, because the desire simply evaporated on its own. You just gave it time to do so. This one habit alone, consistently applied, has been shown to reduce discretionary spending by up to 20% in the first month for people who track it. 20%, without cutting a single subscription or eating a single sad desk lunch. This one sounds trivial. It's not. Every time a website asks to save your payment information and you click yes, you are removing friction from the spending process. And friction, in the context of money, is your friend. Friction is the moment between wanting something and buying something. That moment is where decisions actually get made. One-click purchasing was not invented to help you, it was invented to collapse that moment to zero. The habit is to delete your saved card details from every retail website and app. All of them, Amazon, ASOS, food delivery apps, everything. Force yourself to physically enter the card number every time. 16 digits, expiration date, CVV. It sounds annoying. It's supposed to be annoying. That annoyance is doing work. Studies on payment friction show that even adding 10 seconds to a transaction can reduce impulse purchases by a measurable margin. The inconvenience is not a bug in this habit, it's the entire mechanism. Most people budget in reverse. They spend the month, then look at what they spent, then feel vaguely guilty about it, then do the same thing next month. This is accounting, it's not budgeting. Accounting describes the past, budgeting shapes the future. The habit here is zero-based budgeting in its simplest form. Before the month begins, you take your expected income and you distribute it entirely. Every dollar gets a category: rent, groceries, transport, savings, entertainment, whatever. The point is that when the month starts, every dollar already has a job. When your entertainment budget hits zero mid-month, you don't dip into grocery money. You're done for the month. This is not about being restrictive, it's about being intentional. There's a difference between choosing not to spend and being surprised by an empty account. One feels like control, the other feels like failure. Zero-based budgeting sounds complicated. It's not. You can do it in a spreadsheet in 20 minutes. The mental shift it creates is worth far more than 20 minutes of your time. This habit works particularly well for anyone who overspends on physical stuff. Clothes, gadgets, home items, anything that takes up space. The rule is exactly what it sounds like. Before anything new comes in, something old goes out. You want new running shoes. Fine, which pair are you getting rid of? You want a new kitchen gadget. Which existing gadget leaves the drawer? This creates a different relationship with acquisition. Instead of asking, do I want this? You are now asking, is this worth losing something I already have? That is a harder question. It should be. It forces you to audit what you already own before you add to it. There is also a financial side effect. When you regularly give away or sell the outgoing item, you either recover some money or you develop a clearer sense of just how much money evaporates into things that eventually end up in a donation bag. Both outcomes are useful. Everybody has one. For some people, it is restaurants. For others, it is clothing. For some, it is online shopping at midnight. Whatever your category is, the one where you consistently overspend and feel worst about it afterward, that is the category where you switch to cash. Here's why this works. Paying with cash activates what behavioral economists call the pain of paying. When you hand over a physical note, your brain registers the loss differently than when you tap a card. Brain imaging studies have actually shown this. The insula, the part of your brain associated with negative feelings, lights up more during cash transactions than digital ones. Credit cards in particular are specifically designed to suppress this feeling. The pain is delayed to the end of the month, buried in a statement, softened by reward points. By the time it arrives, it has been decoupled from the pleasure of the purchase. Cash recouples them. You feel the spend in real time, and you stop when the envelope is empty. Not because you were disciplined, because there is literally nothing left. The single biggest savings mistake most people make is saving whatever is left over at the end of the month. There is usually nothing left over at the end of the month. This is not a coincidence. It's Parkinson's law applied to money. Expenditure rises to meet income. If the money is available, it will be spent. The solution is to make it unavailable before you ever have the chance. The habit is an automatic transfer. On payday, before you see the full number in your account, a fixed amount moves to a savings account. Ideally, a separate one that is slightly inconvenient to access. Not impossible to access, just not one-tap easy. Even a small amount compounds into something significant. $200 a month at a modest 5% interest over 10 years becomes over $30,000. Not because you were disciplined every month, because you were disciplined once on the day you set up the transfer. This is the closest thing personal finance has to a cheat code. Avoidance is one of the most powerful forces in personal finance. People who overspend are often people who have stopped looking at their accounts because looking feels bad. But avoidance does not make the numbers better. It just means the numbers get to grow quietly in the dark, compounding in the wrong direction until there's a crisis that forces you to look. The habit is a weekly 10-minute check-in. Same day, every week. You open your bank app, look at what came in, look at what went out, and compare it to your plan for the month. That's it. No judgment, no shame spiral, just information. The consistency matters more than the duration. 10 minutes a week is 520 minutes a year. That's less than 9 hours. In under 9 hours a year, you can maintain a clear and honest picture of your financial position. Most people spend more time than that choosing what to watch on streaming platforms in a single month. The awareness alone changes behavior. It's hard to keep overspending in a category when you see the number every week. The visibility is the intervention. This one is free. It takes about 30 minutes to do once, and the effect is almost immediate. Retail emails exist for one purpose: to create desire for things you are not thinking about before the email arrived. They tell you about sales on items you would never have sought out. They remind you that an item is still in your cart, sitting there, waiting, as if it misses you. They announce flash events and early access and member-only prices that make you feel like ignoring the email means missing out on something valuable. Most of what's in those emails is not valuable to you. You know this, and yet the email works because the desire is manufactured in the 30 seconds it takes you to read it. Unsubscribe from all of it. Use a tool to batch unsubscribe if you have to. The version of you who discovers a sale is always a more expensive version. The version of you who was not thinking about that category at all is the version who keeps money.
There is a particular kind of spending that modern life has perfected. Spending you forget you are doing. Subscriptions are the masterwork of this category. They are engineered to feel small. $7 a month, $12 a month, $14.99 a month. Each one feels trivial in isolation. Together, they are anything but. The average person, when asked to estimate their monthly subscription spending, underestimates the actual number by 40%. 40%. People are paying nearly double what they think they are paying for services that in many cases they use rarely or not at all. The habit is a quarterly audit. Every 3 months, you go through your bank statements and list every recurring charge. Then you ask 2 questions. Did I use this in the last month, and would I actively choose to sign up for this today if I did not already have it? If the answer to either is no, it is gone. Cancel with the same ease you signed up. One cancellation call you kept putting off might be $17 a month, $204 a year, leaving your account silently forever. This sounds like advice your grandmother might give you. The behavioral economics behind it would fill a textbook. Emotional state at the moment of purchase is one of the strongest predictors of impulse spending. Research from the Journal of Consumer Psychology found that sadness in particular increases willingness to pay by as much as 30%. Sad people pay more for the same item compared to the same person in a neutral emotional state. Boredom drives online shopping in ways that would alarm most people. A significant portion of late-night e-commerce purchases happen not because someone needed something, but because someone was sitting with nothing to do and their phone was nearby. The habit is simple recognition. Before you open a shopping app or website, you ask, "Why am I here right now?" If the answer is anything other than, "I specifically need to purchase a specific thing," you close it. You find a different response to the emotional state. Walk, read, call someone, do anything that is not buying. The purchase was never going to fix the hunger or the boredom or the sadness anyway. You knew that. The habit is just making you acknowledge that you know it before the transaction completes. This is a perspective shift that sounds minor and hits surprisingly hard. The price tag on something is an abstract number. $200 sitting in your bank account is an abstract number, but $200 as a portion of your actual working hours is something your brain can feel. If you earn $25 an hour after tax, a $200 purchase is 8 hours of your life, a full working day. You handed an entire working day to a clothing brand for a jacket you will wear 6 times. The habit is to do this calculation before significant purchases. Not every purchase, just the ones that are decisions rather than necessities. You take the price, you divide it by your hourly after-tax wage, and you sit with that number for a moment. This is not about making every purchase feel like suffering. It's about making the cost legible in a currency you actually understand. Time is the one currency people tend to be more protective of than money. Make the exchange visible, and the decision often makes itself. Saving money is not a goal, it is a direction. I want to save more is the financial equivalent of I want to get healthier. It sounds like a plan, it functions like a feeling, and feelings without structure evaporate under the pressure of a Tuesday afternoon when you are tired and there is a sale on something you did not know you wanted until 15 minutes ago. The habit is specificity. I am saving $18,000 for a home deposit by December of next year. I am building a 6-month emergency fund of $14,000 by next March. I am eliminating my credit card balance of $4,000 by June. Specific goals do several things that vague intentions cannot. They create a finish line, which makes the sacrifice feel temporary and therefore bearable. They allow you to track progress, which generates motivation, and they make the cost of overspending visible, because now every unplanned purchase is not just money out of your account, it's time added to your timeline. People with written financial goals accumulate significantly more wealth over time than people without them, not because the writing is magic, because the writing forces the thinking. When you identify a spending impulse, you have 3 options, and applying them in order is a useful habit. First, delay it. Use the 72-hour rule. Wait and see if the desire survives. If it does, downgrade it. Do you actually need the premium version, or will the standard version accomplish the same thing? Do you need the brand name option, or is there a less expensive alternative that serves the same purpose? In consumer goods, the difference between a $40 item and a $140 item is frequently the label and the marketing budget, not the product. If it survives the downgrade test and you still want it at the lower price point, then you evaluate whether to buy it or delete it entirely based on your current financial position. Delay, downgrade, delete. Not as a moral judgment, as a practical filter. Most spending decisions become much clearer when they are passed through all three before a card is ever touched. This is the habit that most financial advice gets exactly backwards. The instinct when you want to spend less is to ban yourself from entire categories. No eating out this month. No new clothes until next year. No discretionary spending at all. This almost never works. Restriction without flexibility creates pressure, and pressure eventually finds a release. People who ban categories entirely tend to overspend in dramatic fashion when the ban breaks, which it usually does. The alternative is barriers instead of bans. You can still eat out, but you move restaurant money to a separate cash envelope, and when it's empty, the option simply isn't available anymore. You can still buy clothes, but only after selling or donating something existing first. You can still make discretionary purchases, but only from a designated discretionary account with a fixed monthly allocation. The barrier is not punishment, it's just structure. You're not telling yourself no, you're building a system that makes yes a more deliberate and bounded response. The spending still happens, it just happens inside a container that can't expand beyond what you choose to put in it. This last one is not a tactical habit, it's a cognitive one, and it might be the most important on this list. Most people, consciously or not, communicate their financial position through spending. A new car, a nice restaurant, a designer item, these are signals to others and to themselves that things are going well, that you are successful, that you are doing fine. This is the most expensive social habit in modern life, because the person driving the 5-year-old car and wearing last season's clothes and eating at the mid-range restaurant might have $200,000 in index funds and a paid-off credit card, and the person with the new luxury vehicle and the designer wardrobe and the permanent dinner reservation might have negative net worth after you subtract the debt carrying all of it. The visible signals say one thing, the balance sheet says something completely different. The habit is to start tracking your net worth, not your lifestyle. Every month, you add up what you own and subtract what you owe. That number is your actual financial position. And over time, if these habits are working, that number should be moving in one direction. Not because you stopped enjoying your life, but because you started spending in ways that align with what you actually have rather than with how you want to be perceived. Here's the uncomfortable thing about all 15 of these habits. None of them are new information. You've heard versions of most of them before. The 72-hour rule, automating savings, tracking subscriptions, these are not secrets that the financial industry has been hiding from you. And yet, the average household debt keeps climbing. The savings rate keeps fluctuating near its historic lows. People keep buying things they can't afford on cards that charge 20% to own items that will lose most of their value before the balance is paid off. So the question is not whether these habits work. They do. The research is clear and has been for decades. The question is why knowing isn't enough, why the gap between understanding a thing and actually doing a thing is so wide and so consistent and so profitable for the people on the other side of every transaction you've ever made. That gap between what we know and what we do is worth sitting with, because the entire architecture of modern consumer spending lives in that gap, and it is very, very good at its job. The habits in this video are not about closing that gap through willpower. They are about shrinking it through design, one small decision at a time.